Good evening, my dear members. Welcome you all for the study circle meeting. So today's topic is going to be disclosure of foreign assets and foreign tax credit under the Income Tax Act. For this, we have a very renowned speaker, CS Bharath Lakshminarayana. I request CA Kavita Parmesh, Bangalore branch chairperson, to escort him onto the dais and welcome him over the podium. I request CA Kavita Parmesh to give the welcome address for the gathering.
Good evening everyone and welcome to this study circle meeting on foreign tax credits and foreign assets disclosure. I'm sure all of you are in the midst of tax filings and this is one of the key topics. Every year there is some new challenge coming up. I have been also seeing these tax returns and then especially this foreign tax credit thing. There will be new situation where you have some doubts and you have to go back. So that's why we thought that it is apt that we do this session now. And the timing also, we did it in 15th because if we do it next week, then I know half of you will not turn out. So this is the best time we thought. Thank you for being here, and I'm sure we have Mr. Bharath Lakshminarayana. He is an expert on this and he will definitely be able to clarify most of your doubts and give you a lot of insights about this with his experience and experts. Please take most of it. And sir, thank you for being here. I welcome you to this session, sir.
Thank you. It is my privilege to introduce today's eminent speaker. CS Bharath Lakshminarayana is a BCom and Company Secretary. He has over 20 years of experience in the field of taxation. He focuses on advising clients on Indian domestic tax and cross-border tax issues, tax optimization strategies, transfer pricing and exchange control matters. He also regularly attends to matters involving representation before the tax authorities and income tax appellate tribunal. He has spoken at Bangalore branch study circle at ICI and at the Chamber of Tax Consultants on topics relating to income tax, transfer pricing, exchange control and money laundering. In May 2025, he deposed before the Select Committee of the Lok Sabha to examine the Income Tax Bill 2025 on the sections relating to transfer pricing, taxation of charitable trust and provisions on research assessments. In March 2026, he also appeared and contributed to discussions at the Bharath 2026, a policy reform and responsible action for Mission Viksit Bharat, organized by the CBPT. So with this brief introduction, I present before you today's speaker, Bharath Lakshminarayana. Over to you, sir.
So, like Kavita madam mentioned, there's an innocuous amendment every year. We hope there are no surprises in the returns as of now. At least they don't seem to be very significant or troublesome. And that's where I personally believe this year there's some bit of stability in the tax return, and next year, any which ways, we'll have to keep our fingers crossed. So maybe this is the last year of stability, and then from next year we'll be back to square one. Let's just hope things pan out very well. And this particular topic for today, foreign tax credits and foreign asset disclosures, they've seen a lot of evolution over the past 10 years, I would say. There are some innocuous amendments. Not much care is typically taken at the time of disclosure for various genuine reasons. And as they say, the chicken come home to roost when either we get an intimation from the CPC under 143(1)(a), or many years later we get a notice from the intelligence wing saying that there is some foreign asset in which your name has popped up, but where have you filled your foreign asset disclosure appropriately? And the number of such cases have increased over the past 4-5 years, I would say. And that is when the full gravity of the disclosures that all of us helped our clients make about 7-8 years back, we were able to see the full impact. And particularly with the increased focus on attacking money laundering, attacking the Benami, we've seen that these particular sections, if not the foreign tax credit, the foreign asset disclosure sections in the returns, they become very, very crucial, and whether the manner we make a mention of some fact in those sections is of most importance. Foreign tax credits, primarily the litigation has been around filing of this Form 67. Otherwise, the scrutiny of the tax office on the foreign tax credit claim itself has not been very intensive, I would say. If there are claims in the returns, particularly for corporates, they go ahead and inquire on the backups, the underlying evidence, and if that is broadly appropriate, they go ahead. The focus has never been on whether that foreign tax which has been paid outside India has been rightly paid, and therefore we do not see much controversy in the issue of foreign tax credits. So this will be a fairly straightforward dimension, but foreign asset disclosures are quite sensitive. So we will keep that in mind as we traverse to the next couple of hours. So foreign tax credit is the easier section to deal with, and this is the first topic for today. Only 2 points, but we'll spend a little time on some nuances, and we'll take questions at the end. So what I would request is, if there are any queries which come or clarifications, then if you would need, if you could make a note of it, we will revisit them at the end of the session. So first of all, foreign tax credit, I'll just walk all of you through the concept. And the first 10 slides are primarily on this concept of foreign tax credit, as to what this is all about, the first principles. Because this is the first check which we would need to do when we populate the income tax return. It is mandatory for us to go through the double taxation avoidance agreement and see how the foreign tax credit will be made under that particular DTAA. So these are some first principles under the DTAA on foreign tax credit, and then we go to the relevant parts in the income tax return, where this is to be disclosed, how this is to be reported, how do we compute, etc. So the first point on foreign tax credit is just like we have credit for domestic taxes. So there is a tax deduction which happens, which we claim a credit when we compute the self-assessment tax. Similarly, on income which accrues or arises outside India, that particular country levies a tax and remits or permits the remittance of the balance amount. And the point is, this amount which is deducted or which is paid in that overseas jurisdiction can be claimed in India. Sections 90 and 91 permit this to be done, because without sections 90 and 91, foreign tax credit fails. So the key provisions which enable us on this issue of foreign tax credit are sections 92, 90 and 91. Section 90 applies when there is a double taxation avoidance agreement with a particular country, with India and a particular country, and tax is withheld as per that double taxation avoidance agreement. Section 91 deals with scenarios where there are no DTAAs. If there are particular countries with which India does not have a DTAA, India says, it's okay, default is the DTAA, I will grant credit unilaterally. Section 90 and a DTAA acts bilaterally. So if between India and US, and I'll take that example of India and US throughout this next couple of hours. India and US have a DTAA. The name is a double taxation avoidance. Alright? Means that the primary focus of that agreement is to avoid double taxation. And the most important way in which the DTAA achieves that objective is through the foreign tax credit mechanism. Thereafter come, in that sense, thereafter come the other provisions of allocation of taxing rights. So what DDAAs typically do structurally are they enable tax residents of one country to claim credit of taxes paid in another country, and they also allocate taxing rates on select sources of income between the two countries. So for example, if we take India and US, with respect to say social security receipts from US to India. So assume I am receiving some social security benefits from the US. The DTAA says that only US has the right to tax that income. India does not have the right to tax that income. So what that means is that if I get I'm a resident, I'm an ROR, I'm taxed on my global income as per the Act, but the DTAA tells that no, on this social security income, you will not pay a tax in India, you will pay a tax only in the US. Right? So that is how the DTAA allocates taxing rates. There are other instances. If we take royalty, FTS, dividends, interest, business profits. If there are say dividends which I receive from US to India, the DTAA permits both countries to levy tax. It permits US also to levy tax, and the state of residence, which is India, can anyways levy a tax there. But to the extent of taxes paid in that country, a credit will be given. So only in exceptional income streams, like social security, is when the DTAA tells one particular country not to tax that income stream. Otherwise, typically, they say, okay, both of you can tax it, but the resident country should give credit of that tax which is with you. The DTAA contains the framework for all of this. DTAAs have been there for the past, I would say, easily about 50 years. So the question is, foreign tax credits, are they being claimed for the past 50 years? The answer is yes. So large multinationals from India who had operations in countries other than India used to make these foreign tax credit claims. It used to be very difficult because until say Rule 128, there was no structural mechanism to give effect to the credit provisions in the DTAA. So the grant of tax credit used to be quite unstructured and ad hoc and whimsical. Right? There was only the broad principles which the DTAA used to lay down. And then how the credit had to be given was left to the discretion of the tax officer. We can make the claim, but he could deny the claim for whatever reasons. Fortunately, not much litigation on this happened, because fortunately we on particularly foreign tax credit claims, we had fairly a very receptive income tax department. As long as we gave them the proof that tax has been paid outside India, they used to admit it to such an extent that if we give them backups, say for example China, some services were provided to a client in China. The client paid the money after deducting tax in China and he sent the balance to us. The proofs used to come in Chinese. We used to have them translated and then we used to file it with the tax office. They used to accept it. They've been fairly liberal on this aspect. But it was important that a more structured mechanism comes into claiming foreign tax rate, because there were a lot of nuances. As you will see, there are a lot of nuances. And that is when Rule 128 was introduced a few years back. After a lot of pressure and lobbying, because large multinationals, particularly from Bangalore and Mumbai, were facing some difficulties with the FTC claims. Alright, and they made a lot of representations before the CBTP, and that is when Rule 128 was promulgated. And that is where today the sections of the ITR also reflect the Rule 128, which we will see a little later. But before that, just go through quickly the first principles on foreign tax credit. So like I said, relief from double taxation is one of the principal basis for a DTAA. Double taxation is due to residence versus source rule of taxation. So an Indian resident earns income from the US. So that income has a source in the US. Typically today, most countries in the world follow the source basis of taxation or the residence basis of taxation or a hybrid basis of taxation. Right? India is a classic example of following the hybrid basis of taxation. For non-residents, we tax India's sourced income. Right? But for residents, we tax global income. So India follows a hybrid system. On the other hand, the US adopts the source rule. It also adopts the citizenship-based rule of taxation. So as long as you hold a US passport, you are required to file a return in the US. You may not have stayed even a day in the US, but if you hold a US passport, you are required to file a return in the US and pay taxes also on select income streams. On the other hand, Singapore follows for corporates a territorial basis of taxation. Therefore, only if income hits the Singaporean territory or Singaporean bank account is when Singapore taxes that income. So, if a Singapore company keeps its income offshore and does not bring it within the territory of Singapore, that income is not taxed. Therefore, around the world, different countries adopt different systems of taxation. And because of this lack of uniformity, double taxation inevitably is seen. And that is where the DTAA comes to alleviate the difficulties caused by double taxation. Taxation of residents on worldwide income, taxation of citizens on worldwide income. So that is the example of the United States. Taxation of residents on worldwide income, what India does and what UK does, typically a lot of countries do. Dual residence. In India, we are here, if we have 182 days or 60 plus 365, there's a residency trigger. But other countries have different parameters. The threshold could be lower. If the threshold is lower, that same individual or that same corporate, whichever entity, could become a resident of both countries. In this situation, what is to be done? Is the question which comes up. And that also is addressed by the double taxation avoidance agreement in its article on residence. Inconsistent classification of income. So what may be royalty as per US law will be business income as per Indian law. And because it is royalty, it suffers a withholding tax or a TDS in the US. Whereas at say 15% or 10% or 20%, but in India, it suffers a tax at 22%, 25%, 30% on a net basis. So gross basis of taxation, net basis of taxation, so all of these things collide together to trigger double taxation. And therefore relief should be given. In India, like I said, relief is unilateral or bilateral. Wherever there is a DTAA, it becomes bilateral. Wherever there is no DTAA, it becomes unilateral. And the mechanism of the foreign tax credit is the most important objective of a DTAA. And I think that is also because of this policy objective of a DTAA. FTC is something which is typically not disturbed by our income tax department also. What they go on to challenge is characterization. Whether you offered the entire amount to tax, whether that has been reported, etc. They typically do not trouble us with foreign tax rate. They trouble us with other sections of the DTAA. And that's why this whole field of international taxation is a big area of practice altogether. FTC is not an area of practice. All pieces apart from FTC are the area of practice. It starts from residence. If we see the article on residence in a DTAA, rather, it starts with definitions. It starts with article 1, it starts with scope. Who does it extend to? So for example, partnerships, does it extend to pass-through entities? All of those things are questioned. All of the questions are still unresolved. Right? Each article of a DTAA right, has triggered enormous litigation. So, for example, on shipping, Article 8, right? We in Bangalore may not be very familiar with Article 8. We are more familiar with Article 7, Article 13, Article 14, Article 12, etc. But if we go to Bombay, if we go to Jamnagar, if we go to Vizag, if we go to Calcutta, Article 8 is the most discussed article. That is simply because Article 8 talks about shipping income. And because these cities have very strong port infrastructure, a lot of ships, foreign ships keep coming and exiting. The question is whether their entry and exit has resulted in taxable income in India. And Article 8 is a very relieving provision. If we see somewhere in the 170s series in the Income Tax Act, there is a specific question, a specific section dealing with taxation. How do we complete assessments of shipping entities? Right? So each article of the DTA has triggered enormous controversy. In India, even FTC should have triggered that controversy. Fortunately, it has not triggered that controversy. And that is really nice because when we claim FTCs, and like I said, the response has been more or less favorable. The litigation has been on a very small area which we will deal with a little later. Then comes this concept of juridical double taxation and economic double taxation. This is again one of the founding principles as to why DTAAs came in. Juridical double taxation, same income being taxed by multiple jurisdictions affecting the same taxpayer. These are our classic examples of, say, dividend, business profits, etc. When I get a dividend income from US, that income is taxed in the US, that income is taxed in India, and it affects the same taxpayer. Right? That is juridical double taxation. Economic double taxation is when the same economic income is taxed in different hands. This is where the concept of underlying tax credit, etc., comes, which we will deal with later. When a company earns profits, it is taxed on those profits. All of us know that corporate tax, etc. And after paying the corporate tax, there is something left, and from that, if a dividend is paid, right, there is again a tax on that dividend. So if you see, economically it's the same income. Economically it's the same income, but it is being taxed in different people's hands in different ways. Right? The objective of a DTAA is to primarily address juridical double taxation. Economic double taxation, it addresses only exceptional scenarios. India, Brazil, India, Mauritius are the only treaties, major treaties, which address economic double taxation. Right? Lot of guidance as to how to act on a foreign tax credit claim has come from the OECD Model Tax Convention. And like I said, DTAA allocates taxing rates, etc. So the Model Tax Convention has set some basic rules as to how this is to be done and why it is to be done. So for example, the threshold for taxation of business profits is different from the threshold for taxing dividend, interest, royalty and FTS and capital gains. The thresholds are different. Why? Business profits are taxed on a net basis. All of us know that in PGBP we tax it on a net basis, but salary is taxed on a gross basis after some quarterly deductions. But if we see first principles, salary income and income from other sources are effectively taxed on a gross basis. The deductions are nominal. Contrast this with income from house property, where the deductions are fairly decent. Business income, where the deductions are substantial, right? We can claim a loss also. And capital gains also, where we can claim losses in exceptional situations, right? But under the DTAA, If there is a royalty, there is a dividend, there is an interest payout which happens, the taxation is on a gross basis. But that same royalty or FTS income enters business income section in the Indian context and it gets taxed on a net basis. Are you able to visualize the contrast? While the Indian tax law says I will tax fees for technical services on a net basis, the DTAA says that I will do it on a gross basis. So, on a net basis, I may be suffering a huge loss, but I will have to endure the TDS in the US on a gross basis. What is the remedy? The remedy is to file a return there and claim a refund. But the DTAA says nothing doing. FTS is taxed on a gross basis, sorry. And therefore the question comes, in India, if there is a loss, if there is a net loss, will I be able to get a refund of the tax which I paid in the US? This is the question which comes. Right? I am a net loss in India, but I have suffered TDS in the US. Can I get a refund of taxes paid in the US from the government of India? Right? Unfortunately, these points are not addressed by the OECD model. Very foundational aspect. So that is where the OECD convention is wanting, so to say. It says, yes, I will give exclusive right to tax to the state of residence except in select cases. Okay, so what is that? Business profits are typically, the right to tax is given primarily to the state of residence. The exception is when that entity triggers a permanent establishment in India. Only then will the state of source have a right to tax that entity. Similarly, DIR and FTS, dividends, interest, royalty and FTS. Capital gains also in some instances. The first right is the DTAA start with the fact that I will allow the state of residence only to tax it, but then it says no, but I will allow the state of source also to tax it. That is the second point. In other articles, taxing rights are not exclusive and are given to both the states. So, these examples are taken. Since both the contracting states may tax the same taxpayer on the same income or capital in accordance with the provisions of the treaty, relief is needed to avoid the double taxation. And the phrase which I have mentioned in quotes, in accordance with the provisions of the treaty, absolutely critical. I will get a tax credit in India only if the TDS or the withholding in the US has happened in accordance with the provisions of this treaty. Simple example, dividend. In the US, a US company has paid a dividend to an Indian entity. As per the India-US DTAA, the TDS on dividends which US can levy is 15%. The TDS is done at 25%. Right? The TDS happens at 25%, and in India, I want to claim TDS of 25% because now I cannot get that extra time back. I mean, it's a nightmare. So, I would want to claim TDS on 25, but the TDS in accordance with the provisions of the DTAA is only 15. So the question is, will I be entitled to claim the excess 10 in India? The answer is no. Or, on a particular payment, it was business income, it was not fee for technical services or royalty. On a particular payment, no TDS was supposed to be deducted, but they deducted the tax and they remitted the balance to India. They gave us a certificate saying this much is the deduction which has been remitted to the US government treasury. You can claim a credit. Now, if that payment was not at all subject to tax in the US, but tax has been deducted, the question is whether we can claim a credit in India. Answer is again no, because the tax deduction is not in accordance with the provisions of the law. And all of you will be familiar with the long history of software taxation in India. Right? All of you are familiar? Is there anybody who is not familiar with software taxation in India? I can give a quick brief in a minute. Yes. So, users in India used to subscribe or purchase software from non-resident vendors. Say for simplicity, let's take American vendors. So the American company used to sell software. It used to courier them, or today it is allowed for electronic download. The question is whether payment is to be made to the US entity, tax is to be withheld in India under the provisions of the India-US TTW. Is TDS required? On domestic software payments, we are clear that TDS applies unless they give a certificate. The same question first came up in the cross-border context, whether tax is to be deducted on software payments. And some taxpayers used to deduct tax, some taxpayers did not deduct the tax. The income tax department went behind all those taxpayers who did not deduct tax, saying that as per the Act and the DDAA, the payments for software constitute royalty, and therefore you should have deducted tax at 15%. That was what the income tax department said. Now, the people who made those payments, they have made the payments, right? Now the question is, now department has come after 3 years and telling them, boss, you should have deducted tax. I will disallow this under section 40. I will also initiate proceedings under 201. Fine, companies, they challenged this position. The department also went behind the non-resident vendors, saying, you have earned royalty income in India, you have not paid taxes in India, you should have paid taxes in India as royalty. Their point was, under the definition of royalty, the software payments are taxable in India. The question which would come, yes, for the Indian vendors, it's a genuine concern, they will litigate. Now the question is, these non-residents, if they had paid 15% or 10% tax in India, the question is, couldn't they have claimed a credit in the US? They could have claimed a credit in the US. It's only a cash flow timing issue, right? From the time of deduction to the time of filing the return. But the question which came up in the US was, is a tax deduction in India in accordance with the provisions of the DTAA, so as to avail the credit? Because the US IRS took a position that software payments are not royalty, they are business income. And therefore, all these non-resident vendors, they could not claim the credit at all. Therefore, it was a cash loss for them. And therefore, it became imperative to get to a clear position on this issue. And that's where this matter came to be litigated for 25 years. Finally, to hold that it is not royalty and therefore TDS is not required. That's why this phrase, in accordance with the provisions of the treaty, becomes extremely important. And therefore, whenever our clients come saying, on this income which I have got from outside India, there is a tax which has been withheld, the first question we have to ask is whether it is in accordance with the DTAA. First question. Okay. As the prior taxing rights remain with the source state, the relief provisions under this article apply to the state of residence only and not to the state of source. And that's why this question that these US non-resident vendors, they could not claim a credit of that in the US. The only way out for them was to file a return in India and say that this is not royalty, therefore kindly give me a refund of the entire tax deducted in India. And that's when the litigation travelled all the way to the Supreme Court. Because the relief provisions apply to the state of residence only, not to the state of source. State of source was India. They could not claim credit in India. They had to file a return, say I am not liable to tax in India, and then claim refund. That's why all these principles are mentioned in the OECD Model Tax Convention, and this was the ramification which it had. And the same is the issue with capital gains, the same is the issue with interest. Whenever all these foreign companies challenge these positions, it is primarily for these reasons, that there will be some difficulty in claiming the credit, tax, leakage, etc. are, I would say, secondary. Primarily this difficulty, it will be a genuine cash flow issue. For example, non-resident, when we purchase some software on the internet and on the web, and we purchase it with a credit card, the payment happens in dollars, right? what if we deduct tax and then give the amount to them? First of all, they will not accept it. Right? But assume for a moment that would have happened. Apart from Microsoft and all of the big names which we know, many of the software vendors, platform vendors are all startups. Many of them are still suffering losses in the US or whichever home country. And therefore, any tax deduction in India will typically become a loss for them. And therefore, they push back, they resist strongly efforts to deduct tax in India. And that's why these concepts of equalization levy, this taxation on digital payments became such a big issue globally. Because the uncertainty on this was eating away into the cash balances of companies around the world. And that's why we see overnight, we saw the equalization levy being abolished also. Again, there's a lot of history around why all of this happened. These are all small points which don't even come up in the newspapers, but there will be enormous implications why these things would have happened. And one of the primary reasons why all of that happens is because the FTC mechanism is insufficient. The FTC mechanism has some kind of difficulties in whichever country. It could be in India, it could be in the US, it could be in Brazil. It boils down to FTC. That's why FTC is the core of a DDAA. Credit applies only if taxation in the source state is only in accordance with the provisions of the DDA, like I mentioned. Two methods for FTC, the exemption method, the credit method. A contracting state may use a combination of two methods. The treaty lets the domestic law and practice decide how each of the two methods should be applied. This is what the OECD Model Tax Convention had been saying from the 1960s. That there are these two methods. You guys choose which you want to do. But the domestic law should set out the manner in which the two methods should be adopted. In India, although in sections 90 and 91 were there, the specific mechanism was not in the statute book till Rule 128, which was only a few years back. So for about 50 years, we managed without a mechanism, and we managed it fairly successfully. The controversy, if we see, if you just do a Google search on controversies on FTC, we will find a lot of write-ups, but we will not find litigation. Anyways. Exemption method can be in two ways: full exemption, exemption with progression. So I'll just give examples for this, and all of you can relate to this concept. Credit method can be in the following modes: full credit, ordinary credit, tax-sparing credit, underlying tax credit. We will focus primarily, and I would request all of you to kindly note that ordinary credit is the most important mechanism of foreign tax credit. And in our income tax return, it is this ordinary tax credit which plays a more critical role. Full credit, yes, in some situations it will. Right? I'll give some examples so that all of you can relate to it. But the credit method, and in the credit method, the full and ordinary credit are what are relevant. Exemption method, like Social Security, I'll come back to it again. Tax sparing, underlying tax rate, I'll explain the concepts. And in India, given Rule 128, prima facie, there is a difficulty on claiming tax sparing and underlying tax rate. Prima facie, we have to litigate. Full exemption method, what is this? Simple illustration. Income earned in the country of residence 10 lakh, income earned in the country of source 3 lakh, total income 13 lakh. Tax liability on above, let's assume it is 83,000 rupees. Total income applying full exemption under the FTC is 10 lakh. In the sense, on 3 lakh, right, India says, I will not tax it at all, I will fully exempt it. This is a case like I was mentioning Social Security in the US. An Indian resident receives Social Security monies from the US, that suffers this fate. Social Security is not at all taxed in India, so that income is excluded in computing the Indian tax liability. So my total income will be 13 lakh, but the income on which I will pay tax is only 10 lakh. Because 3 lakh is exempt because of the DTAA. With me? Because of the DTAA, 3 lakh is exempt, or the DTAA in the FTC section can make a specific mention saying on these items please give full exemption. It can be in two ways. Typically what the DTAA do, they say that the resident state cannot tax it at all. Only the source state can tax it, etc. That is the full exemption method. Exemption with progression is something like a kind of a slab. So it's a improvement, rather not an improvement, a few steps backward from a full exemption. In the sense that this is something similar to how we tax agricultural income. Agricultural income is exempt, right? But it is considered for rate purposes. A concept analogous to that. 10 lakh, 3 lakh, 13 lakh tax liability on a whole 83,000. Effective tax rate is 6.4%. That is 83,250 by 13 lakh. Total income is 10 lakh, applying full exemption. Tax liability on the above, we will charge some tax at the effective tax rate. Okay, this is a concept. There are no DTAAs which India has entered into which have implemented this. This is a theoretical framework. The OECD says you can do this, but in India it is not. It's only in the books. Sorry, it's not even in the books. It's only in the textbooks. Sorry, not in the statute books. Right? Full credit. This and ordinary credit are the classic cases which we will deal with. Income earned in the country of residence 10, 3, 13 lakh. Tax paid in the source country on 3 lakh is let's say 5%. So 15,000. Tax liability in the country of residence on A is 83,250, and therefore net tax liability is 82,250 minus 15,068. What is the principle? What is the premise behind this? The premise behind this is that the tax paid in the source country is lesser than the tax in the state of residence, 9% and 5%. Because the tax rate in the source country is lesser, we will mostly get full credit. This typically happens whenever there is a situation where the source country has a lesser rate of tax than the country of residence. On the other hand, instead of 5%, if it was 15%, instead of 5%, if it was 15%, what would be the situation? Is when ordinary tax credit comes. Yes? 5% and 9%, we get full credit of 5%. But if it is 50, we will not get full. Unless the DTAA says so. What does this mean? Kindly visualize this. If assume for a moment the DTAA said so, that 15% I will give credit, that means 15 rupees has been withheld in the US. Okay. In India, we are supposed to pay 9 rupees. On the other hand, I will claim in India that boss, I have paid 6 rupees extra to the US government. You, Indian government, give me that 6 rupees back. See, the taxpayer is indifferent as long as he gets the money. But then look at the government situation. Why will the government of India pay the taxpayer something which the US government has? All of us know, fortunately, because of 26 years, our TDS credits are safe, fortunately. If not for 26 years, even our TDS credits were in jeopardy. Right? Now visualize this situation. Why will the government of India give credit for taxes which are lying with the US government? That is a simple premise as to why full credit works only in this kind of a scenario and not in a converse scenario. Right? And that's where we spill over into ordinary credit. And this is the typical set of instances. Income earned in the country of residence 10, 30, 60,000. tax paid in the source country is 20%. Tax paid in the source country is 20%. Tax liability in the country of residence at say slab rate is 83 to 50. Effective tax rate is 6.4. Let's assume effective tax rate is 6.4. ETR of the income from source state is 3 lakh into 6.4%, 19,200. Net liability is 83 to 50 minus 19,200. So what does this mean? This means that you paid excess tax in the US. That is a past. End of story. I cannot give credit of that in India. If you want to do anything about it, you have to go to the US tax authorities and do it. How does that happen? I mean, it appears unjust, right? I mean, it appears, boss, we lost, the taxpayer has lost. That is where, in India, we see the situation of lower TDS, nil TDS certificate 197, Form 13 and all of this. Why do we do it? Why do we go for that? Because if we are in a loss situation, if the taxpayer is in a loss situation, anyways he will not be paying any tax. That's why he goes to the department, says, boss, give me a lower or nil tax deduction certificate because I am in a loss situation. And therefore I will not be liable for tax at all. Therefore, please permit no TDS deduction from all my customers. Something similar is available in India for non-residents as well. Non-residents also can file an application under 197 and say that I am earning losses. Please permit a lower TDS. Now, what the AO there can do is, he can say, okay, but if he calls it out as royalty, his hands are tied. Because the law has prescribed a tax rate on royalty, FTS, etc. If that income constitutes royalty or FTS, he cannot give a TDS certificate for lesser than that number. What he can definitely do is, if he is convinced that this is business income, then he can say, okay, let the tax liability TDS happen at 0.1%, which is still better. Which is still better than 10% or 15% or 25% or 35%. And that is where we see a lot of litigations around this area. Right? Because finally they will only get an ordinary credit over there. Just like we in India cannot ask the government of India to pay, this guy cannot ask the US government to refund taxes which the Indian government has taken. Same analogy. And that is where the ordinary credit gives some relief, but even its hands are tied. And that's where domestic law, the local income tax act provisions like that, they contain provisions to dilute the effect of these prima facie difficult situations. So ordinary credit is the typical mechanism which is also today being incorporated in the income tax return form, and there are a lot of nuances. This is a very simple example. We will go to the forms and we will see some difficulties which come up. Tax sparing credit and underlying tax rate I briefly explain. Interest income of say Indian tax resident from say government of UAE, which is exempt from India tax under the India UAE DTAA, is 4 lakh. Tax payable in India at 20% is 80,000. Tax credit, assuming India UAE DTAA tax rate at 12.5% is 50,000. The tax payable is 30,000. So, what tax sparing credit does is it gives credit of taxes spared. What do we mean by sparing? Taxes not charged. This is a unique concept in a DTAA, in a cross-border situation, and it is done only for specific purposes. Right? This is like saying, in our normal TDS context, the TDS is 100 rupees, but I will give you a credit of 150. Form 26 says reflects 100, but the provision says I will give you a credit of 150. This is something similar to that. And what is the premise? The premise is, to the extent of the tax spared, I will assume that tax has been charged and I will give you a credit. I will assume that you have paid some tax, and on that tax which you have purportedly paid, I will give you a credit. This is present in the India-Mauritius DTAA. In the India-Mauritius DTAA, this is manifested when the DTAA says we had 10A, 10AA, 10B, SEZs and all of those favorable tax regimes. Under those regimes, those companies never used to pay tax. Correct? But the shareholder in Mauritius would get a credit of taxes not paid in India by the company. Taxes paid. Taxes paid in India, Mauritius used to give a credit, and that is where the effective tax rate in Mauritius used to become 0, and that is where the India-Mauritius DTAA became a very famous DTAA. Because it had this underlying tax rate. Kindly visualize. We had 80HHC and all of that from the 90s, and until 21-22 we had 10AA. So for a period of roughly 30 years, India used to give tax exemptions for tech companies, export-oriented entities. If shareholders were based out of Mauritius, they would have gotten benefit of the taxes paid in India, and that is where there is so much pushback on Mauritius. This was one of the USPs. I mean, it's not unique. There are multiple selling propositions of the India-Mauritius DTAA. This is one of the selling propositions, and that's why when something was done to the India-Mauritius DTAA, all of us used to read it in the papers. Right? Similarly, underlying tax rate gives you credit of corporate taxes paid. So forget 10AA, etc. If normal corporate taxes were paid, the shareholder would get a credit of that. So it's like, just to give a more closer example, partnership income. So partnerships are taxed at 30%. When partners withdraw profits, withdraw capital, etc. When they withdraw profits, there is no tax both in the hands of the partner and in the partnership. So what is it? There is only one level of tax. Right? Just visualize if this partnership scenario would give a credit of the tax which that partnership firm had paid. What a fantastic bonus it would have been. Right? That is underlying tax. Again, this is there in the India-Mauritius DTAA. That's why India-Mauritius DTAA was a bonus DTAA. And that is where it was used extensively for the past many years. With that, we will close the concepts of foreign tax and land right into India. So like I said, many years until about 2012, ITR sought very little information on this species. So if you see, there is very limited litigation on the foreign tax rates until recently. Even today, closer scrutiny on this matter is not undertaken, although this is a cause for scrutiny. So as part of the CAS reasons, this comes up. But in very few instances, they make a lot of ruckus about this. As long as we give the backups, we are fairly comfortable. That's why we do not see a lot of litigation on this even to this day. Evolution in the ITRs on FTCs and manner of processing in recent years, this is what has triggered whatever litigation is there on FTC. So what's happened? After Rule 128 came in, Rule 128 also said if you have to claim a foreign tax credit, you have to file what is called as Form 67. Only if you file Form 67, we will give you a foreign tax credit. Unfortunately, many taxpayers did not file this Form 67. They ended up filing this Form 67 during the assessment, or before the CAT appeals, or before the DRP, or for the first time before the tribunal, or not even before the tribunal, etc. And there, the plea which was taken is Form 67 is a form, it's not a substantive provision, it's a procedural provision. And a procedural infirmity or irregularity or an error cannot vitiate the substantive claim. So today we see on foreign tax rates, the lot of litigation is only on Form 67. Either it is not filed or it is filed wrongly. In the Form 67, instead of claiming 150, is claimed 100. During assessment, they realize this. So they file a letter, sir, see, the proof is there for 150. I erroneously filed the Form 67 for 100. I will file the revised Form 67. Please grant me the credit. AO says no. Litigation is around this. And today what has also happened is foreign tax credit, if we see, is connected with foreign sourced income. And foreign sourced income from about 2008-2010, overseas income rather, has been a focus around the world, not only in India. In India, we have always known the only thing rather all of us know was Swiss black money, Hawala. Right? Those were the primary undisclosed, cross-border undisclosed scenarios which we knew. Slowly we got to know that people used to buy assets outside India. They somehow used to send money outside India somehow. Right? They used to accumulate assets outside India. And this became a big issue. And it had snowballed big time by about 2008 when the Panama Papers came for the first time. So Panama Papers were a set of leaks which had happened, which said a lot of people have unaccounted money around the world and particularly in tax havens. Right? It hit the US really hard. US, UK have always been propagating tax havens for the past 300 years. Right? So if you see Grand Cayman Islands, British Virgin Islands, Singapore, Isle of Man, right? Those are all known tax havens. Who promoted them? It was either the British or the Americans. For that matter, even to this day, UK is a fantastic holding company jurisdiction. So if Indian companies have to do as they call outbound investment, if they establish one SPV in the UK, it is very helpful. Because why? If we go back 300 years, the exporter of capital, as they say back then, was the UK and the European countries, Netherlands, France, and that's why we see very favorable tax regimes even to this day in those countries for shareholding activities. In India, shareholders, capitalists are looked at in a very different way compared to the way those people are looked at in the US, UK and in Europe. There they are promoted, here they are put behind bars. Right? It's a philosophical difference. And that's why UK as a national policy, right, it promoted tax havens around the world. Jersey Islands, all these exotic islands. Mauritius is a French colony finally. Right? Mauritius is a French colony. Singapore was a British colony. Right? Jersey, Isle of Man, Ireland are all outposts of the UK. US Virgin Islands, Bermuda, Panama for that matter, are all UK, US, American protectorates. And those guys, as long as it was convenient for them, they promoted it. But the chicken came home to roost, so to say, when the Lehman Brothers crisis happened in 2008. US suffered an economic collapse, and that is when they realized, boss, to come out of this economic collapse, the government needs money. All our own people have done enormous tax planning with our blessings and stashed money outside the US. Now that money has to be brought back to the US. What do we do? So they went behind their own progeny. They went behind their own spawn. They blacklisted Bermuda. They blacklisted British Virgin Islands. They blacklisted Cyprus. Cyprus was a UK protectorate. It was a British protectorate. Right? They got them blacklisted. Their own children they blacklisted. Why? The pinch came to them finally. And that is when they said, no, all of you guys should tell how much you have kept outside around the world. And that is when the US enacted what is today popularly called FATCA. A law called FATCA, which required all companies, all taxpayers in the US to report not only taxpayers, but entities in the US, financial entities, lot of specified entities in the US, to report foreign assets. Right? So the first person in the world to tell good morning on this issue is the US, because they felt the pinch. Till then we were also sleeping. Right? And because FATCA came in, FATCA put enormous pressure on the global economic system, because nobody was till then prepared to give this information. The Swiss continue to stonewall the US, and they get blasted. Every time they get blasted. And that's why Singapore, Cyprus, I mean you name all those tax havens, all of them started running for cover. Things didn't improve. In 2013-14 times, the OECD, so pressure came through the OECD to say, boss, base erosion and profit shifting, BEPS, what is called, is a global concern. Like Mr. Jaishankar says, Europe's problems are not our problems. Right? They started project. India has been screaming about black money for donkey's years. Okay, suddenly their problem became a global problem. Anyways, having said that, a lot of reports were published saying something has to be done about this base erosion and profit shifting, and that is where one of the baby steps taken was on disclosures. So foreign source incomes came under a lot of scrutiny, foreign assets came under a lot of scrutiny. And that's where foreign tax credits, since they formed core of the DPAA, everybody saw that FTCs are a good way to capture data on foreign assets as well. Once you get the foreign source income, you will also wonder, okay, what was he doing in the US to earn this income? Does he have a house in the US? All those supplementary follow-up questions started coming. And that's why I mentioned dovetailed with focus on foreign assets. Eventually, DTAs only used to focus on foreign tax rate. Post 2008, things started changing and even foreign assets came to be looked at together. We'll see this a little later. Bilateral FTC, like I mentioned under section 90, unilateral. So there's an innocuous section in the idea. Small section. It starts with this. 89 is our ellipse. 90 and 91 is the core. Okay, one line item. Earlier, it used to be when these forms, when this section came in, it used to be manually we could key in any number. The only thing is we have to be clear that the number which we key in has a backup. Okay, then things evolved. Then 2 of scheduled 3R, 3 of scheduled 3R started. And this is the. And you see how this schedule has evolved. The schedule has evolved with the digitization of our returns. Just imagine populating this in the physical form about 15-20 years back. It would have been very painful. It would have been even more painful for the department to process it. Forget us filling. The department had to process this. It would have been even more difficult. And that's why with the digitization of the returns, processing of this data has become far more elegant. And therefore, country code, taxpayer identification number, total taxes paid outside India, total of C of schedule FSI in respect of each country. I mentioned dovetailing of foreign assets, etc. It started asking about the foreign source income as well. FSI, what is FSI? This is FSI. So, one base schedule leads to another schedule. That schedule leads to another schedule. Right? So we will start with this and then go back, then rewind. Country code, drop down to be provided in the e-filing. Drop downs are there, we need to select and give. Right? You need to be very clear. Hong Kong, China, Taiwan. What to do? China. Hong Kong, Taiwan are part of China. Right? There is some. This used to be a few years back. Now we have a DPAA with China, with Hong Kong. Right? Politically, we know that Hong Kong is now part of China, but we have a DPWA with Hong Kong, which we did not have about 10 years back. Right? That's why the year of transition was a difficult year. Until then, we used to call it out as I think China or something, because some treaty is better than no treaty. Right? But then even that was incorrect, because China was defined in the India-China DDWA. So again, this is a recurring question. Fortunately, now it is settled. That's another point. But deciding which country is also important. Okay, that's the only point I want to mention. Taxpayer identification number. So in that particular country, I would have taken some taxpayer identification number. I will populate it. It becomes important. I will connect this to the foreign assets schedule, because what has happened with foreign assets is what has become a bit tricky. I'll give a classic example in the local context on these numbers. Why keying in this data is also crucial. I'm sure all of you would have faced this difficulty when the charitable trust, when approvals came to be made online, all 12 AAs had a registration number. Right? All of you are able to recollect that many years back. And then, if when we filed the charitable trust ITR, we keyed in this registration number wrongly. If we keyed in this registration number wrongly, it never used to throw an error when we filed the return. But we used to get a 143(1)A saying their exemption is denied, because we would have claimed an exemption. Innocuously, innocently we would have claimed the exemption. We get a 143(1) saying the registration number is not matching with the department records, therefore your exemption claim is denied. And there we would have realized, instead of typing O, we typed 0. And CPCs picked that as an error and denied me the section 11 claim. So we filed a revised, we filed a response to it, rectified it, and we moved on. Taxpayers identification number, why this becomes very important? The government of India, through the FTTR division and their intelligence division, they get a lot of data from other governments as part of the exchange of information mechanism. Even to this day, if we go to there's a website for Panama Papers. So what was Panama Papers? Basically, that leaked a lot of information about offshore entities and offshore assets owned by a lot of individuals. Okay? So, say for example Mauritius, let's take Luxembourg. Okay? Most countries, when a company is being incorporated, they ask as to who the shareholders are. And many countries also used to ask, who is the ultimate beneficial owner? UBO, they used to ask. And they used to keep it in their records. Data from such countries were leaked. And some of those investigative journalists who were behind this data, they compiled a fantastic database connecting each individual to which entity is incorporated in which country. So actually there are those websites which actually map that aspect. And each of them, each individual or each entity had a identification number. And that was a starting point for them to correlate. So for example, if I type the wrong identification number here, and on the other hand, the income tax department is given data which has a different identification number. The name is the same, Bharath Lakshminarayana. They have a tax identification number from Luxembourg. But in the return, I have said Luxembourg, but I have given a different number. It will immediately trigger suspicions. Right? That's why this becomes critical. And therefore, one of the most important aspect in compliances for all of us is the underlying documentation. Right? We always ask the client to give the base data, to give the backup, to give the authentic source. It becomes even more critical here. The reason is because it's not the income tax department which, the assessing officer will come chasing. It is either the foreign assets intelligence unit which comes, or the ED which comes, or the Benami prohibition unit which comes, and the central range comes. The investigation wing comes. One ITO, some junior ITO won't come. And the degree of harassment which the taxpayer has to go through is easily 5 to 10x of the normal difficulties. At least with the income tax department, it's easier to deal with. At least they will listen to us, etc. Not so the other authorities. For example, if we recollect money laundering law, PMLA, black money, etc., income tax used to come not immediate, not at the start, but they used to come in the middle or at the very end. But the first frontline authorities who would come there are the CBI, the police, external intelligence, or some Pandora papers, Panama papers, something like that. Those were the starting points. And there, anything can be information. And there, that's where the only corroboration which we would have is what we find in the return. And that's where this reporting assumes extreme critical importance. Heads of income, salary, house, property, capital gains, resources. This head of income is head of income from the standpoint of Indian law, not American law or UK law. UK law may consider something to be capital gain, but India will consider it to be business income. It could happen. Right? We have to say, under the Indian law, which is the relevant head. Right? So, for example, we have this concept of deemed dividend. Like, what is deemed dividend? Deemed dividend is a loan. Right? A loan is characterized as income under specific such situations as in 222E. In essence, deemed dividend is not income, it is deemed, it's a fiction. Deemed, so a loan is being taxed as income from other sources. Right? That is in the Indian context. Again, in the cross-border context, an income may be FTS, fee for technical services, from the US standpoint, but it will be business income in the Indian standpoint. This is a screenshot of ITR 2, that's why you will not find PGBP. In ITR 3, 4, etc., you will find PGBP. This is a screenshot from ITR 2, that's why you will not find PGBP. But if PGBP is there, if a royalty income, FTS income comes up, you have to mention it over there. On the other hand, dividends. Dividends, if I am an investment company, dividend could be PGBP income. It need not be income from other sources. Right? So, characterization from an Indian tax standpoint is what we have to see. Income from outside India included in part B total income. Right? So here we list it. Now the question which comes is social security. Remember I mentioned that under the India-US DDAA, social security is taxable only in the US. It is not taxable in India. So what does that mean? It is as good as an exempt income. Right? It is as good as an exempt income. Now, this column says income from outside India included in part B TI. Exempt income is excluded from part B TI. It is excluded from part B TI. This is one exceptional case. Otherwise, typically incomes will come. Right? Tax paid outside India, we have to mention here. Tax payable on such income under normal provisions in India. Tax payable under normal provisions. That could be 22%. It could be 15% if it's a special. Right. So, for example, capital gains. Capital gains on the net gain, we may call it out as short term or long term and pay a tax. Right? But if it has come from the US, and in the US the tax rate is far higher than that, say 30% or something. How do we do it? So here, how have we computed the tax on that income applying Indian tax law is what we have to mention. And then tax relief available in India, E is equal to C or D, whichever is lower. This is where this point on ordinary credit which I mentioned. And I said that ordinary credit is what is reflected here. So the question of full credit or higher credit is slightly difficult. And therefore, underlying tax credit, tax bearing credit is not even visualized in the form. Because it says C or D, whichever is lower. Because it says I will give tax relief only on this. So if you claim anything higher, I will not give you the tax relief. So although the DTAA contemplates relief, section contemplates relief, the form does not contemplate relief. These are the nuances which are there, which we have to be careful. Sir, if you can park the question, kindly make a note, we will go back to this later. This is something which we have to try. Relevant article of DTA if relief claimed under section 90 or 90A. So here, relevant article of DTAA, we have to mention the provision under which it is taxable in that country or not taxable in that country. It's not, we have to mention article 23 which talks about FTCs, no. It is article 7, 8, 9, 10, 11, 12, 13, 14, 15, 16. Whichever article is there, we have to mention. Say for example, if it is capital gains, it will be say article 14 or 15. If it is house property, it is typically say article 6. Article 6 deals with immovable property, typically in a DTAA. So that is what we have to mention here. And so for each country, we have to mention this. Now, what about multiple sources from the same country? I got a house property income from two different streams, two different houses in the UK. Right? Now it all depends on the tax which I have paid over there. Whether I report it in two separate line items or club it and disclose it under one line item. Yeah? It means this question will come. The way we have to think is, what is that which will be processed by the department favorably? I have to compare that. With what is the right way of doing it. Right? The right way of doing it is clubbing it. But will that give me the relief which actually has to be given is a question I have to think. Right? And that is where the tax in that country, in UK, becomes relevant and as to how they have computed that tax. Is it in accordance with the provisions of the DTAA? All those checks we have to do. We cannot blindly put in any number. I mean, if it's a one single income stream, it's fine. And if the tax rate in that other country is lesser, it is okay. Right? Because if C is lower than D, we will anyways get full credit. Look at the fun here. If C is lower than D, that is what other country think, they will not even ask questions. Only when it is the other way around is when the client will also sit on our head. Rightly so. Because money is going out from his pocket. So he want to be absolutely clear, and that is where we also have to be doubly clear. Now, look at this situation. If the tax in the UK was 10%, but the TDS or whatever tax has happened at 7.5%. Right? It can happen. For example, this year one of our clients has gotten some income from UK. It's being taxed at 5%. We are not able to check on the net as to why did they apply this 5% rate. It should have actually been 9%. They have charged tax at 5%. We've asked the client why. I don't know whether we'll get an answer. but at least we should endeavor to get an answer. It won't affect my position. But then, assume for a moment in scrutiny, the officer asks, Saripa, 5% tax has been applied. Can you give me the base provision? Which provision will I give him? I will give 9%. Then he will ask the follow-up question, boss, what is this? We are stuck. We are stuck 2 years later. Better to get stuck today than 2 years later. Right? This check is something which we have to do. Again, if we see income from outside India, it doesn't talk about gross receipts. It is income. So capital gains is only the capital gain, not the gross sale consideration. Right? Now, salary, is it gross or net? That is a question which we will have to apply our mind to. Because let's say there are mandatory deductions in the US, just like in India, PF contributions. For a provision of law, it is income. Rightly so. Now, are they mandatory deductions? Are they applications of income? Or overriding title? That is a question which we have to ask. To freeze on that amount of income, are we offering 100,000 pounds or $100,000 in the CTC for a particular period, say, or my take home, which was $900,000 or 900,000 pounds? What is the amount which I will call out as income? Because I have to also be practical. Now, if I offer $100,000 as income in India, at least on PF and all of those matters, I get a deduction. Right? I mean, whatever deductions we get, the law acknowledges it. But if the same thing happens in the US, will the law acknowledge it? And therefore, middle path would be to say, we will take $900,000, the net amount, and the differential, we will offer it to tax as and when we get it. Say 5 years later, this $100,000 or 100,000 pounds will come back to us, something like a PF draw or something of that kind. We will offer it to tax at that point in time. Let us be clear about that today. Because we will have a very clear basis to say why we excluded that the $10,000 and only restricted it to 900,000. Are you guys with me? Instead of 100,000, we offer only 90,000, and say why we have not offered the differential of 10,000. Right? And say that it's not that income is not taxable. That is not income today for this year. Right? The positions which we see from an Indian standpoint may not be feasible there. And that's where the point becomes whether we be technically correct or we be practical. Or we find a middle path. Right? And that's always a challenge. And that's why when FSI comes in, when foreign asset disclosures come in, the return is not a routine return. It is not a routine income tax return. It has its own set of complications. Kindly imagine, you have to read the DDAA. Right? For that we need to know where to find the DDAA. Which article to go through. Right? How can it be a simple return? Right? And then these are the so-called instructions which are there on the website. And it describes it's not very helpful. Only in one case it is helpful. There is one dimension here. We'll go back actually. We're supposed to go back. I just wind this up in about 5-10 minutes, and then I think the break is organized at 6:30. I just wind this up so that we go to foreign assets later. From there we come to this section, country code, again tax identification number, total taxes paid, total relief, tax relief claimed under section 1998A. So here it appears, right? It appears, this last column, it appears as if whatever the DTAA has contemplated, you will get that credit. Right? But it may not be true. right? Because these are not fields which we can populate. These are automatically picked up. So there will be inherent limitations. And we may not agree with the computation here. Because genuinely the taxpayer and having seen all the provisions, we may arrive at a different view on the quantum of tax paid. Sir, we'll take it up later. If you can kindly note it down. So, we have to independently analyze the provisions of the DAAA, compute the tax relief, and then weigh it against the form. Is the form allowing us to claim what we want to claim, or it is not allowing us? And from here, this section gets filled up. One nuance here is this row number 4. Whether any tax paid outside India on which tax relief was allowed in India has been refunded or credited by the foreign tax authority during the year, if yes, provide the details below. Very important and innocuous field. I pay taxes in this year. 3 years later, I get a refund. There was no way for the government to track this. Even though this is a voluntary declaration, kindly see the quantum of faith that the government has in us. No, it is very genuine. I mean, the government is really large-hearted. That's why when I talk about FTC, I'm saying it is large-hearted. It is asking us to say whether you are sure you are not going to claim a refund. It is banking on our honesty. We have to appreciate the government for this. Alright. On the other hand, I mean, we may have 100 difficulties with the government, but like I said, FTCs, the government has been very liberal. See, it asks us this question, boss, you tell whether you are claiming a refund or not. How easy it is for me to say no. Outcome is only wrong verification. I certify, I say that all of the things which I have stated above are true to the best of my belief. Verification, very important verification. That was 100. Government has that faith in us, and we have to appreciate that. And therefore, it also says, the point here is, why should the government of India permit the refund? Okay? And then the other thing is interest on refund, all of that also it wants to cover. So it's a very bona fide question, and it's been asked very nicely. Right? Please see that the consequences of the consequences of a wrong disclosure here are nowhere spelled out in the law. If you don't disclose foreign assets, penalty, imprisonment under black money law. But if here, instead of saying yes, you say no, no way the government will track it. And it's food for thought. Amount of tax refunded, assessment year in which tax relief allowed in India. So it goes back to that year and allows, gives provision for that. Thereafter, these are the. On the other hand, this point that on FTC the government has a lot of faith on us. See the number of questions on TDS credits. This is the schedule on TDS credits. You guys saw the schedule on foreign tax rates. Minimal. 4 or 5 line items, that's all. Kindly see the number of columns here. Carry forward, transfer of credit. Okay? Only to contrast, again TCS. TCS, they are now levied on overseas remittances. That's again become a nightmare for all of us. Because of high TCS, we will have high refund, because of which our case gets selected for scrutiny. Right? FTC, high FTC, things will get over. TCS is a nightmare. He will ask, give me explanation for TCS. Then I have to say, no, I had to send 2 crore to my son for my son's education. Then he will ask, okay, source of 2 crore. I will say part bank loan, part savings. Okay, savings means show statement of affairs. Never ending. Right? FTC, receipt of foreign taxes paid, working, invoice for the base amount, your home. Right? Just to contrast this, I presented this on the screen. And then 128 has those nuances. Credit allowed for any foreign tax paid by way of deduction or otherwise. In the year in which the corresponding income corresponding to such tax is offered to tax in India in a manner and to the extent as specified in the case. So the other difficulty here is carrying forward of the credit. Right? That is the grey area. So now our TDS section has become complicated because of carry forward, carry backward, transfer, and all of that. We have not made that, and that's a challenge. That's a challenge area. Where income on which foreign tax has been paid is offered to tax in more than 1 year, credit shall be allowed across those years in the same proportion in which the income is offered to tax or assessed to tax in India. That's why this position, this third bullet, we need to make up our mind as to we are going to offer 100, we are going to offer 50, and carry it forward. It goes both ways. It goes both ways. And therefore, in this entire slide, in Rule 128, I believe this is a very critical decision which all of us return preparers have to take. If the credit is spread over multiple years, income is spread over multiple years, TDS, all of us, we face this in the local context. We book the revenue in the next year, but the client has done TDS based on provision. Mismatch in 26 years, or we keep getting those notices, right? Please reconcile. Same issue. Right? Just like how we've taken a decision there that we will offer it to tax in the next year, it's the same decision. Where DTA exists, tax covered under the said agreement, DTA does not exist, unilateral. Credit not available for interest, fee or penalty. The tax rate is for tax, it is not for interest, fee or penalty. Credit not available for disputed, instead of R, please read D. Disputed foreign tax or part thereof. Just like the refund situation, the law says if the government has disputed, I will not give you credit. Just like we in India will say that boss, I am not supposed to pay, we will be fighting a similar case there saying I am not going to pay. Don't claim credit of that tax here because you have disputed it. But if it becomes final, I will give you a credit. If it becomes final, I will give you a credit. Again, interest fee or penalty is excluded. Disputed tax allowed in the year in which such income is offered to tax in India, blah blah blah. Evidence of settlement of dispute, evidence that liability has been discharged, undertaking that no refund has been. This is a very simple kind of a requirement. Rate is computed separately for each source of income and then aggregated. That's why the structure of that schedule is between sources, salary, house property, PGBP, capital gains, income, separate sources. Now, if there are multiple capital gains from multiple assets, multiple house property income, multiple other sources income taxable at different rates, they will have their complications and nuances. Right? That will be beyond the scope for today's discussion, that is why I will not take it. But it is a point to ponder. Right? That is a point to ponder. Credit to be lower of tax payable under the Act, foreign tax. Any excess foreign tax would be ignored. Like I said, I cannot claim refund from my government. Conversion rate being TTBR on the last day of the month. Claim to be based on Form 67 and a certificate from or statement specifying the nature of income and the amount of tax deducted therefrom or paid from the tax authority of the year. So this is basically the proof of that foreign tax rate. Now they have said what I need, and this is typically provided. If the certificate or statement is signed by the assessee and not by the authority there, we need something more, which is acknowledgement of online payment or bank counterfoil or challan for payment of tax. So liberal, the government is actually really liberal on this. I have not been able to get a Form 16, 16A equivalent, 26A equivalent. I will give a self-certification and I will enclose the proof of payment of taxes. That they will give the credit. Form 67 to be also filed to report carry backward of losses. So that is okay. Form 67 again a form which replicates the ITR schedule. So if we make up our minds on this, we will be able to fill the ITR. Therefore, first Form 67 we need to file. That is the other process. After filing return, we should not file 67. Before filing the return, we need to file 67. Therefore, we freeze Form 67 and then populate the ITR. If we do it the other way around, 100% we are going to get one CPC intimation. Okay, that's why this is very crucial. Foreign tax rate, first thing we should come to our mind is the freezing of the FTC. After that, we will freeze the ITR. It's the same contents which we discussed earlier. I think this will park it, we'll take it up after the session. Some pointers, I think we've discussed this mostly, but we'll just run through this quickly before we dive into foreign affairs discussion. We will break now. We will reconvene in 15 minutes. Thank you. I note from the audience that there are quite a few queries on ESOPs, ESPPs, RSUs, phantom options, etc. We will take that up. I will wrap up the foreign asset disclosure quickly and then we will take that up. Most important on foreign tax rates, like I mentioned, reconciliations to be kept handy by taxpayer on reporting in the Form 67 is the relevant part of the ITR when the said income is reflected. Foreign asset disclosure if and as applicable. Asset and liability schedule if and as applicable. Because claims in the foreign tax rate will run through all of these sections. And that's why we need to be very clear on how we arrived at that number, or assume for a moment we arrived at a number of 0. So for example, some colleagues here had this question, sir, in the context of ESOPs, RSUs, tax has been deducted there, but we've not offered it to tax in India, whatever, no, there's no money, so to say, which we have to offer. Now, how do we deal with this is the question, which we will take up. But these are critical assumptions which we will make. Can you notice? On this, first we have to go on a fact-finding exercise to understand what is the real situation. I take examples later on, but the point is, on whatever position we take in the ITR as a rule, FTC's foreign asset disclosures, we need to be very clear as to why we are taking a position and why we are not taking some particular position. So if I have been allotted options, I've gotten options on the RSUs, ESOPs as the case may be, but I'm not reporting it in the ITR for whatever reason, I should be clear on that reasoning. Right? From carry forward of FTC in the absence of FTC claim in return, Form 67 is to be filed. Error from CPC to be responded to. So the other, as they say, devil in the room, bear in the room, whatever you want to call it, is how do we attend to assessment proceedings when there is a disagreement with the view which is taken. Right? And that's why I go back to what I had mentioned earlier. We need to be clear as to what is the tax position under the Act and the TDAA. How feasible it is, or how viable is it for the client. And also sit in the shoes, or sit in the chair rather, sit in the chair of the government. More importantly, the CTC. So at least like I was mentioning, foreign tax rate claims before the AO are fairly easily processed. But hurdles are faced by all of us from the CTC. We do not know the intelligence which the CTC is applying. Every year there is a change in that algorithm which changes the intelligence. Right? The kind of defects or intimations which we used to get 3 years back, we are not getting it. We didn't get last year. The defects which we anticipate, rather the intimations which we anticipate when we file this year's return, we actually don't get. We get some other intimations. Right? So this is something which we have to be prepared for. And the only thing which will protect us is some kind of a position paper which documents why we took a particular position. Right? Because that will demonstrate the bona fides of the claim in the return. Alright? Even a non-reporting of something is a claim in the return. I am claiming that this is not there. I am claiming that only this much is my income and nothing more. Right? That's why we need to be very sensitive about that verification form in the verification section in the ITR. It's a very well worded paragraph, and we need to just keep refreshing ourselves with that and not buckle down or be bogged down by our clients' demands and timeline demands. Revision of Form 67 permitted, although AO likely to dispute this. So the question is, can we file a revised Form 67? We can file a revised Form 67. Right? Just like we can file a revised Form 3CD, we can revise anything except a return under those circumstances. Of course, it will be litigated. No doubt about it. Or it will be looked at negatively. And excess of foreign tax paid vis-a-vis tax rate in India. In fact, there is a ruling of the Mumbai High Tax in Bank of India where they clearly said that you cannot claim a refund when you have a loss in India. So you have a loss in India, but you paid taxes outside India, you cannot claim a refund of it. That is specific ruling. Characterization required in Form 67 as per Indian law and ITA 61 and not as per the overseas position. So like I mentioned, how are we calling out an income stream as income, or rather a receipt as an income? What head are we classifying it? We should be very clear from an Income Tax Act 1961 or 2025 standpoint, and not the way they are looking at it from the US. So for example, this is something which will trouble us in the ESOP, ESPP, RSU concept. So, if something is an income as per US law, is it income as per Indian law? Right? Which we will deal with a little later. Yeah, alignment with foreign income and foreign asset disclosure, far-reaching consequences. Information received from overseas jurisdictions would be linked basis PAN and TIN, very crucial starting point. So, this is something which I had mentioned. That the foreign source income will inevitably be mapped with the foreign asset disclosure, and that we also have the asset and liability schedule, right? Unconnected, it appears unconnected with foreign assets, but no, it is connected. Assets and liabilities would also include foreign assets and foreign liabilities. We need to be clear on that. So we have to synchronize all these sections of the idea. Tax credit on rightly paid tax outside India and not wrongly paid. So this is what I mentioned earlier. Timing mismatch. Taxation on accrual basis in India by tax on receipt basis in source country. Taxation on receipt basis in India and in source country. This is the classic difficulty. We will deal with ESOPs specifically on this later on. Income in FSI schedule on gross basis or net basis. So like I mentioned, salary, do we take it as $100,000 or $90,000? Right? It was the same example which I was mentioning here. Relevant for business income and house property income. Because there is the concept of net basis of taxation. Salary, there may not be much of difficulty, but the real difficulty comes with business income and house property income. FTS is taxed on gross basis, but it comes into the business income schedule, and therefore we have a net basis of taxation. So all of that we need to keep in mind. Tax payable under the normal provisions would include the special rates of tax. So if you recollect, if we go back here, just tax payable on such income under normal provisions. Normal provisions would also include the special rates. That's the limited point. Source of the information on the income, most important. Critical red flag for taxpayers, statements from asset managers, authorities, entities matching with bank statements. This has to be our starting point. If we do not have this data, we cannot take a conscious decision on disclosure. So I was mentioning to some of the colleagues who came up on ESOP, RSUs. What is that underlying document? Has an asset been created? Is it income as per Indian law? That's the question which comes up. And for that we need this base statement. We can talk about RSUs because RSUs restricted stock units, all of that is fine. Now what are the restrictions? When will income accrue or arise? The critical question is when will income accrue or arise? To identify that, we need to see the underlying documentation. all of us today are very clear on taxation of ESOPs. It's a 4-stage process. It starts with grant, vesting, exercise and sale. Okay? Income Tax Act has explicitly said that as of the exercise date, the fair value will be considered as a perquisite. That is only for ease. To settle all confusions, in India, the law has said this is what is the position. But the question still comes, has income really accrued on exercise? This is a question which we are entitled to ask. The law only says that I have considered this as a perquisite today. That this need not necessarily mean that it is income. And therefore, that primordial question as to on ESOPs, when is income really triggering? When is the real income accruing or rising to the taxpayer is a question which we have to answer based on these foundational documents. Without these foundational documents, we will be only talking in the air. Right? We will be only speculating. And this is the most challenging part with foreign source incomes. Our clients will not be willing to part with information. Either they may not have it for genuine reasons, or they may not be willing to part with it, or they may know where it is, but their sourcing it itself is a challenge for them. Right? 3 types of problems typically, which is okay, I mean, which is fine. But boss, how do we report it in your idea? Are you willing to take this risk of incorrect disclosure? Then we will go with what you say. Then 2 years later, don't turn around and say, boss, you should have told me. I am telling you today. And as I said, proactively also to the extent possible, if we know that these clients of ours will earn foreign source income, we should beforehand tell them that, boss, kindly organize these details. At the time when you are engaging with a service provider entity, please collate these details, but because I will be asking this information at the time of filing the return, which will be later. So you need to be proactive as well. Else they'll turn around and say, boss, you should have told this to me 6 months back. You knew this. Right? So we need to be very proactive on this data. Because as long as data is within this country, it's easy to somehow source it. Right? But with non-India, it is outside India, it's a challenge. Right? It's a genuine challenge. And therefore, we being proactive, the client will not appreciate it, of course. But we should keep ourselves safe. Right? And as I said, this I marked it in red for this reason alone. May be taxed by source state, shall be taxed by source state. So this was a fairly common issue in the earlier and historically, and it continues to be rather. The question is, if an income stream is not taxable in India because of the DPAA, for example, Social Security. Okay, if it is taxable only in the US, right, and it is not to be taxed in India, should we report it in the ITR itself? Right? Should we report it in the ITR itself is the first question. Right? There are views for reporting it, there are views against reporting it. Right? In today's evolving situation, I would propose for reporting it. Alright, reporting it, calling it out as exempt income. Let's call it out as exempt income. Let him examine why it is exempt. And let us be clear why it is exempt. Because if we say it is not taxable, we won't report it in the income. I mean, we won't report it in the ITR, we will drop it. 2 years later, when the case is selected for scrutiny and then they get this information that there was this income, then we will be seeing stars. On the other hand, if we call something out as exempt income, at least we will be pushed to develop a basis for that position as to why it is exempt. And we would have written, I'm not saying as per India USD standard, as per articles so and so. US alone has the right to tax. Ideally, it should not be disclosed, but from a full disclosure standpoint, I have reported it. Later on, if the department wants to tax it, they can at least not impose penalty. Because I have made a bona fide declaration. Most importantly, I will be saved from black money. Black money is the bigger, black money law 2015 is the bigger sold on the X. And therefore the question is, shall be taxed, should it not be reported in the ITR? For example, as FSI in FSIS, how etc. So my answer to that is I would be reporting it as executive income. Although there is a school which says it should not be reported at all. There is nothing technically wrong. Where I am coming from is the surrounding circumstances today. Say pre-black money law, I would have said okay, it's okay, let's not report it. But then after black money law, I am far more circumspect on this. Some additional issues: belated filing of Form 67. We are aware of non-income tax levies such as cess, surcharge, state taxes, inheritance tax, wealth tax. So the question is, can we claim credit on all of this? Because in US, that is one fundamental piece. Right? Not only the US government levies taxes, but the states also levy taxes. And state taxes are outside the purview of the DTAA. So the question is, what is to be done about it? And that's why there is one position that these are deductible expenditures under Section 37. Okay, this is in the context of business income. Non-business income, what is it? Can we call it out as income which is not reached us by overriding title? Not application, but which is not income by overriding title. Can we call that out and say that this is, say, I take a 100,000 example. 100,000 is the gross CTC. State taxes are about 5,000. And then there are other deductions of 5,000. Do I report 95,000 in the return, or should I report 90,000 in the return? What is the position we said? The state taxes, I cannot, otherwise individual who has only salary cannot claim it under the DTA. What do? I try my luck. I am trying my luck at 90,000. I am saying that 5,000 was never my income. Alright? Or another safer option would be to offer 95,000 to tax. Alright? And pay taxes to that extent, to the extent of that extra 5,000, and claim a refund. For all you know, the refund could get processed, especially if it's a small sum, and we can move on in life. Okay, that is another way. Two ways: either not pay it altogether, or pay it and claim a refund. Source by source from each country as against aggregate tax from each country. I think this is something which I mentioned at the start. These are nuances which will throw up situations where the form will not permit what the law is permitting. Okay. I will keep that outside because that will be a little complex and I have to take case studies on it. How to claim tax paying and underlying tax relief. So like I said, the form disables us from claiming this. We can claim it, but when we put in the numbers, we will not get the results which the law contemplates. Cases of salary income, cases of business income from multiple countries, royalty and FTS, gross versus net basis of taxation, cases of dividend and interest, whether they qualify as such under the respective categories. Very important. Dividend and interest is defined in all of these words are defined in the DTAA. The definition in the DTAA may differ from the US law, say for example, and Indian law. Now, how do we call it out? In our return is the question. In the return, we are very clear that we have to call it out as the Income Tax Act 1961 asks us to call it out. Okay, but from computing the tax rate over there in the US and claiming the FTC, we have to see the definitions as per the DTAA. For example, interest is defined to mean interest from debt claims, interest from government securities, interest from debentures, and there is a residual provision. That the residual clause could read something like any other income pursuant to an indebtedness or an asset right? And that is when the question could come whether this is really dividend, really interest, or is it dividend? And therefore, some of those incomes could straddle both characterizations. And that is where I am coming back to the same point, that we need to see that underlying documentation as to what is the true nature of that income as per the DDW. Right? Case of house property income, rental income from property in US, UK received in India by R1. Again, I dealt with this a little earlier. Gross versus net. How much do we offer to tax? After municipal taxes, before municipal taxes? If we borrowed a loan over there and we are repaying that loan, what do we do? Right? Those are questions which we have to ask our clients. And finally, from a first principle standpoint, it is real income which is taxable. And the litigation in this country in income tax has primarily been on that. What is the real income? Right? These are the accounting income or income deemed as such by the law. Right? So we need to be very firm about what is that income itself. Cases of other income, stipend received by ROR from US, UK apprenticeship. Clients, some of our clients will have children who go outside to study. In the initial years of their stay outside India, they could be residents, or they will be coming back to India for holidays, etc. So that 60 plus 365 they may satisfy. They become residents. Right? Then the question comes, how do we treat this stipend? We have to offer it to tax in India. This foreigners and disclosure we have to do. Right? These nuances will always be there, which we have to track. Social Security periodic receipts, which I think we have. Then we go to foreigners and disclosure. So I think this is something which I briefly touched upon at the start, so to say. Again, this started off very, very innocuously in FY 11-12. There were only 5 line items, very vague, very generic kind of 5 line items. And today we have 10 line items: A1, A2, A3, A4, B, C, D, E, F, G. 10 line items, and the kind of detailing which is required is far, far high than what it was 14 years back. Right? And then, like I said, in 2010 we had the US FATCA which came in, and the rest of the world followed suit thereafter. We had the famous BJP election manifesto of 2014, where they said we will bring back black money. That's why when I was reading, preparing for this manifesto again, BJP is committed to initiate the process of tracking down and bringing back black money stashed in foreign banks and offshore accounts. They will set up a task force for this purpose to recommend amendments to existing laws and enact new laws. The process of bringing back black money to India, what belongs to India, will be put in motion on priority. We will also proactively engage with foreign governments to facilitate information sharing on black money. Most of the points which they have mentioned here, they achieved it. Very next year we had the Black Money Act. And thereafter, what they have failed, which they have acknowledged, is that we have not been able to bring it back. Right? But the action which they have taken on attachments of benami property, laundered money, laundered assets has been phenomenal. And it is expected, especially given the powers which they have. But they have achieved some bit of it. The only thing, like I said, what they have not achieved is bringing back black money stashed in foreign banks. I think that is the only thing which they have not achieved. But if you see all of the others, they have achieved it. Minimization of generation of black money, I go back. This I don't know whether they have achieved. Right? But cross-border hawala has definitely come down significantly, although the intra-country circulation of cash has increased. Right? It's gone back to pre-demonetization levels, or it's kept pace with the growth of the Indian economy. It's kept pace. The speed at which we are growing, the GDP is growing, black money has, cash circulation has grown. But then tracking down, they have achieved. task force they set up, they made amendments to existing laws, phenomenal amendments. Amendments have continued to happen. Bringing back black money is something which they have not been very successful. Rightly so, I mean nobody is being successful. I mean, even US hasn't been successful. Trump is now trying to reverse outsource and he's facing so much backlash. Forget black money. Because outsourcing itself has been a challenge for him. Forget black money. Right? So I think we can be lenient, although I mean, but they have achieved significantly and we need to be proud about it. And then there were the Panama Papers in 2008 and the Pandora Papers which came in 2016-17. Again a set of leaks. Right? And pursuant to the Pandora Papers, actually both Panama and Pandora Papers, lot of proceedings were initiated under the Black Money Act. To such an extent that action was sought to be taken for pre-2015 black money. And that's why a lot of litigation came up as to till what point in time will you apply these black money laws, money laundering, black money, benami, till what point in time will you take them? So for example, the question came, bank account was opened by the assessee's father in 1990. It was closed in 1996. Proceedings were initiated under the black money law in 2023-2024 tax. Account opened in 1990, closed in 1996. Proceedings initiated in 2023. So the question which is coming up is before the courts, till what point in time will you take it? Right? It's become so sensitive. And therefore, when we see these foreign asset disclosures, if the bank account is dormant, please report. Nil balance, please report. Which we will deal with a little later. And this is the instruction. Unfortunately, this year it's very brief, but in the earlier year ITRs, in the instructions, the explanations were a little more detailed. Right? So these are the many parts of the schedule, and it says so many things. This last but one para, I'm not sure. Can all of you see the last but one para? This schedule ensures accurate foreign asset. Are you able to see it? Yeah? Yeah. Yes, no? And because I zoom it, I try zooming it. Just no? Yeah. This schedule ensures accurate foreign asset reporting and helps the IT department assess cross-border holdings and income for residents. It is mandatory for all resident taxpayers, except in the case of individuals who are not Indian citizens and were non-residents in the earlier years when the foreign asset was acquired, provided no income is derived from such asset in the current year. Extremely important clarification. Yeah. Just read it again. Except in the case of individuals who are not Indian citizens, so basically US citizens, okay, and were non-residents in earlier years when the foreign asset was required, provided no income is derived from such asset in the current year. We have a lot of cases where non-residents are Indian residents today, but US citizens. They are not Indian citizens, they are US citizens. Okay, they will hold a PIO card or whichever card, all of that is fine. Provided no income is derived, they need not report. But if they derive income, they have to report. The short point is, if they derive the income, they should report. There is another exception which we will actually straight away take up and close. So just a second. Yeah. kindly let me know if you're able to see the note here. Yeah. In case of an individual not being an Indian citizen who is in India on a business, employment or student visa, an asset acquired during any previous year in which he was non-resident is not mandatory to be reported in this schedule if no income is derived from the asset during the previous year. Now I don't know whether this clarification is an improvement of the previous sentence which I read. So, who is in India on a business, employment or student visa. So, US citizens who are now settled in India. He said, boss, I don't want to live in the US, I have a good community settled in India, I want to stay in India. Correct? Are they on a business, employment or student visa? Therefore, for them, all the assets should be discussed. When we go back, we saw that it was not required to be discussed. This caveat was not there. This visa business was not there in the previous note. But the note is there only here in the return. This presents a difficulty. Right? This presents a difficulty, and here I would veer to this position of what is stated here rather than the instruction. Right? Because finally, this is the notified form, and this makes a lot of sense compared to not having this requirement. Because classic example, non-Indian citizens, if they are settled in India, right, they would have accumulated a lot of assets, and the Indian government deserves to know about it. On the other hand, these three categories are purely temporary residents in India. They will be here for a temporary period. Business, employment or student visa. They will be for a very temporary period. And therefore, it will be right to ask them not to report it. That's all. The point is temporariness. Right? This is an important caveat. So, with that we go to the first please. Part A, rather Schedule FA, like I said, has 10 items. A is broken up into 4, A1, A2, A3, A4. Right? Details of foreign depository accounts held, including any beneficial interest at any time. Now, let's just quickly run through A1, A2, A3, A4. A1 is foreign depository accounts. A2 is foreign custodial accounts. A3 is foreign equity and debt holdings in any entity at any time during the calendar year. A4 is foreign cash value insurance contract or annuity contract held during including any beneficial interest. B, details of financial interest in any entity. Right? We go back now. These are very when this requirement was first set, all of us were taken aback by the choice of phrases. Foreign depository accounts. We had never heard of foreign depository accounts. The only depository which we had heard of was NSDL. We had not heard of any other depository till then. And then similarly, foreign custodial accounts. What are custodial accounts? This is also a new concept. Equity and debt interest. Since we know a bit of English, we could understand. Foreign cash value insurance contract or annuity contract. Somebody who is familiar with the insurance world may be able to explain this. Okay. Then comes financial interest in an entity. Because we knew a little English, we were wondering what is A3 and B. How different is A3 from B? That is why at around the same time, amendments were made to the rules to bring in 114F to 114H. Those rules eat away easily about 50 to 60 pages in tax and income tax rules. Right? That is a reproduction of the American FATCA. So basically, the US had started requiring disclosures from financial institutions, and financial institutions who have interests around the world. And therefore the Indian government thought it fit that let us align it with their requirement. And therefore they brought in FATCA provisions in the income tax rules. And therefore all these phrases are all defined in FATCA. And therefore in Rule 114F. The definitions themselves run to easily about, each definition runs to about 3-4 pages. Extremely dense English, as if Indian income tax is not complicated. This is worse. You guys should try reading it. And that's why at least I personally am very thankful that I'm in India practicing income tax. And I will only sympathize with US tax practitioners as to the English they have to deal with. Anyways. So now the question is, what are these foreign depository accounts and what are these foreign custodial accounts? Right? And that is where there is a very elaborate definition on foreign custodial, all of this. So like I said, rules 114F to 114H and the CBDT guidance note. There is one CBDT guidance note also on these rules which explain what this is. Depository accounts, which is what is mentioned here, is different from depositary accounts. I have marked O and A in red. Okay. These are American concepts generally. The depository we know is this A, DEPOSITARY. NSDL, CDSLR, DEPOSITARY. What happens there is there are equity shares which we have deposited over there, and the authority NSDL, CDSL, they hold a title on our behalf on that particular asset, and it's a very limited set of assets on which they can actually do that. Primarily equity shares. Right? That is all that we know. But in the US, they use this phrase to mean many more things. They not only demat accounts but also brokerage accounts are what are covered. So we also have running balances with our brokers. In India, we have running accounts with say Zerodha or stock brokers. Those come under A2, depository, right? FATCA use bank accounts as depository, bank deposits, FDs. They come under depository. Brokerage demats come under depository. Custodial accounts, custody. So an asset is held in custody. The premise in the US is that it is held in custody. Right? Similarly, retirement accounts. Okay. So thereafter, the next question which comes is, if I own shares in say Apple Inc., alright, I cannot own it like in my personal name, etc. I have to operate through a broker and I have to have a custodial account there. So if I give details of the custodial account, should I give details of the underlying shares as well? In India, what we do, in India, we have our brokerage account. What accounts we have with our brokers? If we give that statement, we know what are shares, how many shares we hold, right? And that is something which comes in our statement of affairs in India. We directly take that in our statement of affairs. We don't say brokerage account with Zerodha, 25 lakhs. No, we give a breakup. Script-wise, we give a breakup. Right? In the US, it doesn't work that way. They simply say Zerodha account so and so. No, the question in the Indian context, which is peculiar to India, is whether I give the custodial details, now should I give the underlying share details also? That is a question which comes only to us Indians because we are used to doing that. Right? This is a case where it is damned if you do, damned if you don't. If you disclose it in both places, the question comes, is it double reporting? Alright? If you don't report it, we are doomed to say this is black money. Right? And that is where the better situation again is to report it. And keep the explanation that the detailed breakup is the underlying shares The summary is the custodial balance. Right? Then we'll go back to the table. In that backdrop, if we see the contents of the table, it appears fairly straightforward. Provided it is straightforward, provided we get the underlying documents, since we are doomed. Okay? Country name, country code, name of financial institution, which bank, blah blah blah. Okay, these things have become murkier in India also. So, if say for example, many HNIs particularly, they work with banks who keep their entire portfolio. They will have a relationship manager who keeps their entire portfolio, and he keeps giving one portfolio statement. And if you see the portfolio statement, we will see their holdings of shares, we will see what all bank accounts they have held and which is managed by this banker. Alright? He gives that statement, and then sometimes that statement will not match with that bank statement. We face a difficulty in India. Alright? We will face the same difficulty in the US. Right? Not only will typically HNIs, say for the overseas advisors also will give some statement. We have to tie it up with the base statement. That is the trickier part. And that is the address of financial institution. Who is financial institution? Is the question. Is Kotak, say for example, Kotak is managing both the Indian accounts and the US assets of that client. Do we say Kotak? Or do we say DSP, Merrill Lynch, Morgan Stanley, whichever? Who is it? So, address of financial, name and address becomes very important. Why? Because these financial institutions file with the US IRS, and they will give my account number, they will give my name, they will give my address. So what will happen? I have not reported that institution, but the department gets information that from that institution saying there is an investment. Now I will be asked to explain this. To which I will say, no, boss, I will put everything in custodial accounts. See, whatever. Let us be clear on the disclosure. That's why this name and address of financial institution also becomes crucial, because that way we'll be running some filings from there, which we will not be able to see. And we don't even know what the department has seen. They will simply ask us questions. Right? So we need to be careful here. Zip code, account number. Again, for the same reason. Status, account opening date. We have to get this peak balance during the period. Fantastic data point to ask. Right? Why? And then see closing balance. Peak balance, closing balance. If there is a significant difference between the two, easy inference, which even we guys won't bother to make. In the sense, we won't ask the client, boss, it was $1 million peak balance, it has become $1,000 closing balance. What happened? It's a question for us first. Then the department will also replicate the same question. Did you dispose? Did you liquidate? Where is that money? What did you do with it? That's why these two data points become extremely interesting. Gross interest paid, if there is any income, what has gotten paid? That is something which has to be recorded. Similarly, foreign custodial accounts. So custodial accounts include the brokerage accounts, demat accounts, retirement accounts, etc., which I mentioned. Same content, country code, country name of financial institution, address, zip code, account number, status, account date, opening date, peak balance, closing balance. This account opening date is a pain. If you are doing it for the first time, if that guy, especially if he's come to India and has become an ROR, he was in the US or in the UK for donkey's years, now he's come. He's opened that account some 20 years back. If I ask him, boss, account opening date, be in trouble. Even he won't know. At least for us, the passbooks are bank passbooks. We really have to appreciate our bankers. We curse them so much. But account opening date they mention in our passbooks. It is not so easy with those guys there. Peak balance, because why this is relevant? Account opening date is for that example you said here. Account opened in 90. closed in 1996. Black Money Act proceedings initiated in 2023. If it's a more recently opened bank account, it's a different case vis-a-vis an old date. Old date means the question will come, boss, why did you open that account 30 years back? What were you doing there? Then he said, no, I finished my MBBS from Bangalore Medical College. I went to the US. I settled there. I was a doctor over there for so many years. How that story will come? See, such an innocuous request for information, the kind of questions it throws up. Okay? You need to be sensitive about that. Gross amount paid, created, drop down to be provided by the Bharath. Yeah, and here, the other piece is a drop down to be provided specifying nature of amount. So, if there is redemption of financial assets and interest income from the same asset, two separate line items. So, assume for a moment I've liquidated part of the account. It will come as redemption. And on the balance, I have accumulated some interest or dividend. I have to call that out. Right? And this characterization, sorry, one point I missed. This characterization of interest or dividend is a very, very tricky task with non-overseas investments, because the kind of vehicles, investment vehicles which are available in those countries. In India, we know the kind of investment firms which are available. Of late, we are seeing IFSCs, AIFs, then funds, many types of funds. US has many more of them, such that if you invest in units, you may not get a dividend, you will get interest. In India, if we invest in units of a mutual fund, only thing which we get is dividend or capital gains. But in the US, you may get dividend because that fund may have invested in a company. You may get interest because that fund could have invested in debentures or securities of another company. It would have got an interest, it would have passed on the interest to us. Therefore, merely because we hold units in a fund doesn't mean the only source will be dividend. It could be interest as well. That is what we have to track here. And that's why I was mentioning the underlying document. So, and typically the way these guys operate is, this fund has given me interest of, I have about 50,000 units in this fund, LP, investment fund LP, limited partnership. Then those guys will send one statement saying your bank account is credited $20,000 as interest. First question, boss, why are you giving me interest? I have given you capital. On capital, you have to give me profit, which is dividend. And that is that question which we have to ask them. Because the tax rates are different. For interest, the tax rate is different. For dividend, it is different under US law. Under the DDAA as well. Right? So this becomes crucial. Equity and debt interest held in any entity. Here we need to be particularly careful in the sense that Apple Inc. shares, we shouldn't show it here. Because Rule 114 and FATCA understands foreign equity and debt interest differently. Alright? How does it understand them? It understands them as investments in mutual funds, VC funds and investment vehicles. It doesn't mean shares. Foreign equity, debt interest, if you think that we know a little bit of English and we apply common sense, we are doomed. What that part requires is investment in mutual funds, VC funds, investment vehicles, not equity shares. Equity shares come in B. Right? That is the important piece here. And that's why even for A3, this total gross amount credited with respect to the holding, total gross proceeds from sale redemption, this becomes important. Just like here, it was clubbed in one column, here they have split it. Right? And again, kindly see this. This is for March 26. I mean, the return which is due this month. Details of accounts held as on 31st December 25. Sorry, I missed pointing this out. It is as of 31st December 25, not 31st March 2026. No. Simple. It is according to FATCA. US follows calendar year. They have taken the same thing. Only to ensure that there is no duplication or duplication of work can be consolidated. That's why this is an important aspect. So, for example, if the foreign depository account was opened on 1st February 2026, okay, and interest income was received, alright, it will not be reported here. Okay, where will it be reported, or will it not be reported at all, and it will be reported for the first time next year? Right? It's a question which we will have to make up our minds on. If you see all of these parts, A4 talk about 31st December 25, B 31st December 25, C 31st December 25, D 31st December 25, E 31st December 25, F trusts, no date, G any other income derived, not asset. So if I open I have any of those assets from A1 to E in February 2026, it will get reported for the first time next year, because there is no place to report here. But it will come in my assets and liabilities schedule, because that I will draw for 31st March 2026. You need to be careful on this and not be anxious about it. Then foreign cash value insurance contract. So here the point is the only difference is date of contract, cash value or surrender value, total gross amount. Financial interest in any entity is where equity shareholding should be listed. What details does it ask? Nature of interest, direct, beneficial owner, beneficiary, and there's an elaborate definition on what is beneficial owner, what is beneficiary. So the question which comes up is, Bharath owns a company in the US. That company owns another subsidiary company in the US. So in Bharath's return, should he report only the first subsidiary or both subsidiaries? Because the question is, am I the beneficial owner of shares, or rather beneficial owner of shares of that second step down? It's the question which will come. And then there will be better step than sorry, report it. Because what will happen, this second subsidiary would have reported somewhere in the US that its ultimate beneficial owner is Bharath. And that is where, if I don't report it, I will get caught. Because for that step down, I am the ultimate beneficial owner. There is something which you need to keep in mind. Total investment at cost in rupees. Again, kindly note, it is at cost. All these US, particularly US investment managers, etc., when you ask them for portfolio statements, this at cost is very difficult to find. They give fair value. Even in our portfolio statements, we see that Zerodha statements, etc., we see cost and fair value as of March 31st, right? Or market value. In the US, we do not get this data. It's a challenge. So we need to be a bit diligent to get that data. Income accrued from such interest, nature of income, income taxable and offered in this return. Kindly see, these previous parts, they never asked this data. How much income has come from this asset and how much have you offered it to tax? Only this part asks this question. Right? So this is another interesting piece. Immovable property again, similar questions. Now the question is immovable property including any beneficial interest. So under construction apartments, assume I buy a property in Belgrave in London. It's under construction. 5 years later I will get the flat. Till I get the flat, do I have an asset? If yes, should I report it? If no, why? Because the question is including any beneficial interest. Beneficial interest, there is a 3-page definition. Right? That's where While this right in the flat may not come under details of immovable property, I will put it under details of other capital asset because it is otherwise a capital asset. Right? Because I will have right title and interest, RTI. Right title and interest I will have in that property. I can sell it. Right? I can sell it for a premium also. Therefore, it should get reported here. This is the other nuance. And then, any other capital asset head. Capital asset definition similar to our income tax act definition. But the question is agricultural land in US. I will call it out as a capital asset and report it here. Okay? Details of accounts in which you have signing authority. This was one of the first requirements which came when this form was introduced. And then everybody was panicking, saying, boss, all of us directors are signing, the Indian directors are signing authority in the US entity. What do you report? Indian director signing authority in step-down subsidiaries bank account. Report that bank account. Peak balance we have to get. The difficulty was this peak balance investment during the year. Just visualize this for entities who are held by private equity investors, PE investors. Indian PE investors will hold some company. Okay? PE investors won't invest in one or two companies, they will invest in 25 companies. So 25 companies, in 25 companies at least they may have signing authority. Some board resolution could have gotten passed and they would have factored this in the bank account records of the US entity. Saying, this guy is also a signing authority. On an emergency day we take his help. Day to day they may not take his signatures, but on a rainy day they will want him. Therefore his name will be there in US records. Therefore he has to. Right? And the kind of questions that we ask our clients becomes very important. Details of trusts created under a law in which you are a trustee, beneficiary or settler. You are a trustee, you are a beneficiary, you are a settler. Settler straightforward, no problem. Trustee also straightforward. Beneficiary is the question. Because some questions like this, name and address you will get, name and address of trustees you will get. Okay? Name and address of settler you will get, name and address of beneficiaries you will get. Date since position held. As beneficiary, since when did you hold that position? From the date the trust was created. Right? Easy answer. Settler, date since position held. From the date I settled the trust. Trustees since the date I was appointed. Whether income derived is taxable in your hands. For a settler, typically, unless he is the beneficiary, it will be no. Yes, no becomes so crucial. If 8 is yes, income derived from the trust. I have not derived income. Whether income derived is taxable in your hands, answer is yes. If 8 is yes, income derived from the trust, you can always say nil. 0. You will not receive 0. If 8 is yes, income offered in this return, 0, 0, 0. Or whatever corresponding amount. Details of any other income derived from any source outside India which is not included above. This is the category, not of asset but of income. So what's happened? This foreign asset disclosure has also become a foreign source income disclosure. Why this comes up is if I have provided services to clients in the US and I have received incomes, it will come here. Source outside, so there the question is the source outside India? I have provided some tax advisory services to US client. Is the source outside India? The recipient is outside India. Recipient is different from source. Recipient is outside India, source is India only. Why? Because I gave the advice from India. That is what entitled me to the income. Right? So what is source outside India, what is source inside India, we have to be clear. What is source itself, even to this day nobody knows. Okay, I'm sure if any of you attended Padam sir's sessions, okay, he will thoroughly confuse all of us. No, the topic is so dense and so interesting because this very point, source outside India, was challenged before the Delhi High Court as recent as 10 years back in Havel's case. So Havel India, it said, I have exported goods to clients outside India. It is foreign source income. They said the source is outside India and therefore it was trying to wiggle out of taxation, some position they took. Court said, boss, no, your customers are outside India. Your source is in India because the manufacturing and sale happened in India. That is the source. Don't talk about the recipient, and therefore it remanded the matter back to the AO to decide how is the conclusion of contract happening, how did the manufacture and export happen, because some bits of the export were happening, manufacturing was happening in India and some I think was supplied elsewhere. So all of these questions came. So it looks very innocuous, source outside India, but we need to be sure as to what it is. Right? With this, we closed this foreign asset disclosures and then we will move to assets and liabilities. Okay. Assets and liabilities, of course, local assets. Okay, but it also includes foreign assets. Foreign assets, again, specified assets, immovable property, movable assets. Annuity value of insurance contract is mentioned here, it is movable. It is intangible, that is different. It is movable, kindly report it here. Financial assets, insurance policies, all that. There is no residual category here. And therefore, we need to be a little bit careful when we populate this. Liabilities in relation to assets. This is a very, very nice data point. If we borrowed money against something or to fund something, we can clearly mention that. And that itself is an explanation for the assets. Alright, this row C should be populated with care. And again, the guiding principle is to disclose conservatively, report whether or not income received. Don't ask this question, when the client not trouble himself whether he has received income or not. Please report. If he is liable to report, please report. Point of time of reporting, calendar year for sections A1 to E, April 1 to March 31 for F and G. Who is beneficial owner of a company? Who is beneficial owner of a trust? These are all questions we do not know the answers clearly. Documents relating to the asset that is available with the overseas entity. What do these say? That's why when we make an entry here or we decide to not make an entry, we need to see those underlying documents. Peak balance investment, like I mentioned, very important data point. Joint holders accounts, both should report. Joint holders, both should report. Husband, me and my wife, assume we have a joint account. Okay, my wife has no income whatsoever in India, but she has to file a return only to report this. Answer is yes. Nil return, report this foreign bank account. Okay. Second account holder. We have all of this concept. Second account holder, what to please report. Better to report and suffer rather than not reporting and suffering. Nominee. Beneficiary in a will. I am only a beneficiary in a will, not in a trust, only in a will. So what is trust? Right? These we have to deliberate. So this I think we mentioned sub-accounts for multi-currency accounts to be disclosed separately. Even nil balance to be reported. I think all of this we mentioned. Agents, nominees, POA holders, shareholding in corporation, interest in profits, capital of a partnership, reportable, trust where there is beneficial ownership, so and so. Income. So conversion rate is the next question. Income reporting to be in line with income and asset reporting to be in line with Rule 115. So for conversions, we go to Rule 115. D is residual capital asset. E is where even a mere signing authority is required to be reported. Yeah, we discussed all of this. F is the game changer. It came a bit late, but it came finally because globally in 2008 and the BEPS, reports, etc., they acknowledged that tax avoidance evasion happens primarily through trusts. And that was a major challenge area. And that's why this reporting on trusts has stirred the hornet's nest, as they say. One beehive they have touched. Okay, very far-reaching reporting. G is, like I said, it's a table which requires income not reported in anywhere. Residuary to D, gifts from non-relatives. Gifts from friends are taxable. Right? If it is a receipt from my friend in the US, it should come in G. Okay? Very important. Kindly visualize the kind of questions we ask our clients to fill this. Okay, that's the challenge. ESOPs and their variants, how to report. So, like I was mentioning, ESOPs at a grant stage, ESOPs only, not RSUs, ESPPs, not phantom stock units, etc. ESOPs, grant, vesting, exercise, sale. On vesting, options are given. Options are a capital asset. So, to be reported in D. Right? Then, when exercise happens, then at that point in time, there are shares which comes in B. So from D, it goes to B. The very same ESOP. Right? Similarly, ESPP is what happens in reality, is what we have to identify. Right? Without the underlying documents, we will not be able to say whether some rights have been received today or all of these things crystallize only when shares are received. And only at that point in time, I will run a reporting in B. And that is where these questions which we will take up, I am almost done, which we will take up as to if TDS has happened or withholding tax has happened in the US, on what has it happened? Why has it happened? Alright? Individuals with direct subsidiaries, step-down subsidiaries I mentioned. Cryptocurrencies, like I said, any other asset is direct. Right? There is no other place come in the residual, any other capital asset section. Right? If it's a business asset, it talks only about any other capital asset. Is it stock in trade? Ideally, it should not come, but stock in trade, it's fine, we can take that position. But cryptocurrencies can be persist with the same position, especially because of the prohibition in this country. Right? Therefore, if cryptocurrencies are held as stock in trade, I would recommend reporting in D. And giving a caveat saying out of abundant, in the spirit of full and true disclosure, we are making this disclosure. Alright? So yeah, those were some points which I had. I think we can take questions. We'll close some of the questions which we had on ESOPs, ESPPs. Any one of you, if you can describe to me, I don't know who was mentioning that there was a case where there was a TDS which had happened in the US. So if anybody can throw light on this aspect, we can have a quick discussion on the position. So ESOPs, I'm sure all of you understood. It will become options. Options are capital assets. When shares are allotted, we become a financial interest. So now ESPPs on grant, are they a financial interest in an entity? Is the question which we have to ask. RSUs, are they financial interest when they are granted, or that period should expire and only then something materializes? So all of these are dependent on the terms of the plan. Right? These are all very specific to the terms of the plan. ESOPs have been fairly standard today. But ESPPs, RSUs, phantom options, they are very, very company specific, and they may take a call on when to grant what to the taxpayer. Based on that, we need to take a decision whether there is income in the first planning. There is income on the one hand, and whether there is an asset on the other. Right? Income on the one hand would mean a disclosure here, equally a disclosure in the foreign source income piece, equally a claim for a foreign tax credit. Right? A mere foreign asset without an income is a reporting only in the foreign asset disclosure piece, no else. Right? These are the broad principles. I would strongly urge all of you on ESPPs to go back to the source documents and ask these questions. Right? Those are the questions from my side. Yeah, you can take questions.
So if an employee is working in Oracle and he has got RSU, he himself won't be knowing what are the data he has to give to us.
No, he has to know. He has no choice.
Sir, how to get the peak balance, opening balance, closing balance? That we have to disclose, right?
No,
That he
you're
has
talking
only
about,
custodial
one
account.
second. You're talking about RSUs.
Yes, yes.
Now, kindly get the RSU scheme.
Okay.
Okay. First, please ask him, what does he mean by when he says, I've got 100 RSUs? What does he mean by that? Has he got options for the stock units, or has he got the stock units themselves? First question. Secondly, the question comes up peak balance and all of that.
Yes.
Okay. How when he said I've got 100 RSUs, how did he say 100 RSUs? Please ask him that question.
They will download one customer
Correct.
client statement
Correct.
that they will send us.
Correct. So we have to ask for that statement for the entire year and see if there has been any movement. Because it also happens that RSUs are granted in this year, he sells it 6 months later.
Yes.
Peak balance comes up. If we see the statement, just like how we review the bank accounts for our clients when we finalize the ITRs to see debit spreads, peak balance and all, peak credits, etc. we see. It's the same methodology. The point there is getting that statement and being clear as to what is the asset he's received in law and in fact. Okay, in law, legally is he entitled to something? So for example, options are different from shares. Right? Options will not yield him dividends, but shares could yield him dividends. Similarly, these units, ideally they should culminate in shares. Right? Is it a dividend yielding share? Yes, no. That answer he has to give. How will we know? We've not got RSUs. If we get RSUs, we will ask. Similarly, he has to ask us.
Client also.
Then we have to highlight to him the risk, saying, boss, you have to get this. Or we have to find a middle path of not disclosing excess or not under disclosing. We have to find a middle path. There are no two ways. Not reporting is not an option because I do not have the information. No.
Whether we have to report vested shares or granted shares.
Sir, that's what. So, vested options. So, options will get reported as any other capital asset.
Okay.
When options get converted into shares after the exercise period, they will become shares, they will become financial interest. So, they will migrate from D to.
So both we have to report.
There will be some unvested options. Both you have to report. Sir.
Sir, regarding retirement funds held,
Yes.
and there will be some incomes getting accrued over there, which is, only on the maturity they get the money.
Correct.
Should that be disclosed as
No,
income?
exactly. So now the question there is that income really income? Sir, you use this as an income accrued.
Yes,
If it is income accrued,
yes,
but receipt is deferred,
yes.
it is taxable. Because we follow accrual system.
But the client is telling,
Yes.
I'm getting taxed here and over there.
He is being taxed both places.
Yes,
He will have to claim that foreign tax credit.
but we can't claim today because it's getting taxed in a future date.
Correct. So now the difficulty there will come that in the future year we should not offer it to tax in India.
Okay. So for a 30-year-old, he has to keep track of 30 years of tax.
Absolutely. Absolutely. You are absolutely right. He has to track it. He has no choice, unfortunately.
So the peak value,
Sir,
is it in foreign currency or Indian currency?
we have to convert it into Indian currency in considering rule 1.
Which means every month you have to calculate because rupee value will change.
No, sir.
So $500 US dollars
Yes.
valued at 70 rupees
Yes.
and $400 US dollars valued at 90 rupees.
Correct.
So we have to all the days we have to calculate.
No. Peak balance in that year.
Correct.
In
In
US.
that year, there will be only one peak balance.
So Indian rupees you don't know.
No, one second. there will be, say, $100,000 is the peak balance in that account. Assume it is on 28th of May 2025. Peak balance you identified the date.
So peak balance in US dollars.
Yes. To convert that into Indian rupees, we have to go to Rule 115.
No. So this is the last day of
31st May, sorry.
correct. So let's say in September, it comes down to $90,000. But the rupee value has gone down, which is 95 rupees per dollar.
And
That product will be higher.
yes, it will be.
So that's a little bit floating lower.
I agree. But then, these kind of erratic exchange rate fluctuations, they don't happen regularly. Because of some extraordinary event is when that will happen.
Actually, sir, this point I raised when we had a workshop with the income tax people. When this was again discussed, and they were also not very clear. They said they will get back.
No, it's as per 115. They have no choice.
No, but which date we should take?
Last month,
Every month we should do calculate. And
no,
see.
sir, that's what I'm saying. There's only one peak balance.
Indian rupees big balance is no.
Sir, there is one peak balance in a year.
That is US
US
dollar.
dollar.
In US dollars.
Yes.
In that, so let's say, like it gave the example, it's in May. So please take the May exchange rate. The fact that in 9 months later, there's a erratic fluctuation in the exchange rate won't impact your peak balance. In the next year, it could possibly be reflected. And that is where we have to, that is where, sir, what I'm saying is the backups should be clear. See, in the backups, exchange rate doesn't make a difference. Exchange rate is a calculation, Excel sheet calculation with TTBR.
Second question, sir. Euro is a foreign asset. Or no? Because there is a client who is having a ICICI bank account
Yes.
denominated in euro. Does he have to report or not?
Now that we'll go to
ICICI bank in Mumbai.
Yeah. In ideally we got
Because the country, India doesn't show.
we just have to go here. Okay. It says foreign account. It is not a foreign account. It's a foreign currency account.
Denominated, foreign currency denominated.
It's not a foreign account. Sorry.
Thank you.
Sir, in Form
Sir,
67, when it asks what is the tax payable on that income in India,
Yes.
do we disclose the marginal tax payable including surcharge and cess, or do we give the tax at the effective tax?
We have to do it at the effective rate. Because the reason for that is the credit mechanism typically restricts it to ordinary credit, and ordinary credit is subject to the margin.
And in Schedule FA, when we say that where you are signing authority, you disclose that. Do we need to report the accounts that we are already reporting under depository and custodial accounts, or only where we have the signing authority for some other entity?
Signing authority for some other entity. And that signing authority is defined.
Sir, in the case of joint accounts, okay, how you should report whether in both the people's name, then total amount is gross amount, you should not make it 50-50.
I will explain it in assessment.
Okay.
Rather than reporting 50. That is all.
Sir, one question, sir.
We take it off. We take it off.
It's my pleasure and privilege to propose the vote of thanks for this insightful session on disclosure of foreign assets and foreign tax service. On behalf of the Bengaluru branch of ICA and all the delegates present here today, I extend our deepest gratitude to our speaker, CA Bharath Lakshminarayana. Thank you, sir, for sharing your experience, precious time and profound knowledge with the Bengaluru branch. I would like to invite our chairperson, CA Kavita Parmesh, to present the memento as a token of appreciation and gratitude. Thank you, sir. See you all for the next study circle meeting.